the politics of necessity often outweigh ideology. There's more than one way to solve problems, but you first at least have to agree that there's a problem. The spot price becomes infinity. Whatever you're willing to pay for it. Will we see that again? It's going to be very difficult.
So you can be a coal and nuclear bull at the same time.
Yeah, you cannot solve the world without solving China first. Now, over the longer term, Peabody's going to be, I think it's going to be great. I think it's probably a wise move for them. Alpha is going to be the one who will have the most torque in a met coal bull market.
All right, we're on straight from the old line state, which is something new I learned just now, where one analyst is hopefully going to hit all the right notes when it comes down to coal and maybe help me solve some, and you're going to have to forgive me for this, Matt, but help me solve some metallurgical mysteries. Like, for example, why should I care about coal right now? I mean, the media is telling me how dirty of an industry it is and how it's a dying industry and how big money is supposedly pulling out of coal and going into everything that's labeled green. And my neighbors no longer talk to me since I've told them that maybe coal isn't all that bad after all. Maybe the problem with that one was my delivery or my face. But what's the elevator pitch here? Why coal? Why now?
Well, it's a good question. And on my end, it's sort of, I mean, the bottom line is just that we need it, plain and simple. There are two sort of sides to the coal market, if you will. There's thermal coal, which goes to power plants, and there's metallurgical coal, which goes to steel plants. So on the thermal coal side, on the power generation side, the struggle with the energy transition has been that we have eschewed baseload power, which is on all the time, which provides a constant charge to the grid, which is necessary to balance supply and demand. We've eschewed baseload power generation for intermittent power generation in the form of solar and wind and renewables. Uh, my sort of high level take on that is I think that's a fine goal to have, but how you implement it, how you manage that project over the course of 5 years, 10 years, 20 years, an entire generation matters. And the fact is right now we need more dispatchable power, baseload power that you can send out on demand than we do intermittent. If we were able to store all that energy in batteries, if batteries were widely available at scale and at grid scale, we could deploy them. That'd be one thing. But in lieu of that, we're left with coal or gas or nuclear or diesel. I mean, those are your four options on the baseload side. There's run-of-river hydro is not really getting much love either from that standpoint either. But for now, we just need it. Are we going to need it 50 years from now? To be determined. Probably yes. But the question isn't like, is it going to zero? It's definitely not going to zero. The question is, it's going to decline. Just at what pace can we allow that to happen? Is the question. On the flip side, on the metallurgical coal side, there's been a push from mainly governments to green up the steel industry and reduce carbon emissions there. And carbon emissions pretty much just means stop using coke as the reductant and fuel to reduce iron ore FeO2 into molten iron FeO to pick off one of those oxygens and emit carbon monoxide, carbon dioxide, those sorts of things. The difficulty in my view with that is twofold. Number one is that I think blast furnace emissions globally comprise like 7 to 8% of CO2 emissions, and they're really expensive to replace. So we're spending a whole lot of money to get very, very little progress toward any kind of incremental carbon reduction. And that's before we get into, well, you either have to replace the iron ore with scrap, and scrap markets are not yet widely available in Europe, in China. I mean, China's still mostly a blast furnace oriented market. So you need to replace the reductant with something else, and hydrogen has been proposed. But then there's the question of where do you get your hydrogen? Is it from reforming natural gas? Well, that's not quite as green as you really want it to be. Can you do it electrolyzing water via solar energy. We can, but it's really expensive. And so, there are these plants that were supposed to be built. One in Duisburg, Germany, by ThyssenKrupp. It's supposed to be fully funded by the German government. That's pretty close to being dead in the water. And there were two plants, I believe, in France that were going to be half funded by the French government. And given the political turmoil that's kind of engulfed the Macron administration, like I'm not sure that gets done either. So here we have two very well-meaning countries that have set bold goals and may not even achieve them. So to me, it's a little bit too expensive. They're putting the cart before the horse a little bit. In my view, I think the world is naturally going to move toward electric arc furnaces and away from blast furnaces over time. Concentrate on the power gen side, or concentrate on either carbon capture and sequestration, or whatever is regionally appropriate, and just do what you can where you can immediately, and then address bigger issues later. That's kind of how I think things should progress.
It was a long elevator ride, and it leaves us with a lot to talk about.
It does,
but
yeah.
And I can appreciate you saying we don't know what's going to happen 50 years in the future. I stopped trying to predict the future when I got married, because I understood that I cannot predict my wife's moods 5 hours into the future, let alone 50 years. So I did see a chart on Twitter yesterday, though. I don't remember who posted it, but the data came from the EIA on monthly electric generator inventory. And the chart showed that the coal power capacity in the US and how that's going to evolve over the next 4 to 5 years. So still up in the future, but not too far up in the future. And the conclusion was kind of, almost 1/4 of the currently active coal plants in the US were scheduled to retire by 2029. And again, I don't yet know or understand the coal thesis well enough to be able to agree or disagree with it. But what about you, Matt? Is that chart real? Will it have an effect on the coal pricing? What's happening?
It's planned, is the best way to put it. But best laid plans of mice and men, et cetera, et cetera. We've been shuttering coal plants that were, by design, only, sort of built to last 50 years, 60 years, something like that. But we've been retiring them aggressively for a period of time, and then that pace has been getting slower and slower because our power demand isn't falling; it's actually rising. And now, with the advent of AI data centers, it's rising really quickly. I think it's 3% per annum growth this year, maybe another 3% next year. If we're going to grow at that pace, I'm not sure we can afford to retire any of them here at this point in time. And in fact, we may need to restart some in order to meet that demand load. And Silicon Valley, when they go to Capitol Hill, largely they get what they want. And whether that's on the Democratic side or on the Republican side, like the donations are integral to re-elections. So and AI is a great driver and moneymaker for them. So this is the data centers are going to happen. The question is at what pace and what power generation technology are going to pair with them to offset that load. There's a lot of ways to solve that problem, but renewables alone is not necessarily one of them.
But are the power plant life extensions that you're talking about here and that we're seeing, are they about to become more prominent kind of on a global level, or is this more regional, niche, if you will, phenomenon due to the data centers in the US?
In the US, I think that pace of retirement is going to slow, if not stop altogether, for a period of time. At the end of the day, supply and demand always balance, right? So, if we don't, keep those plants online, we just get fewer data centers at the end of the day. So one of those two things has to give. It's either going to be the power demand side, or it's going to be the lack of AI processing capacity. And my suspicion is that this, artificial intelligence is a race that has geopolitical and national security implications. And I don't think the United States believes itself to be in a position where they can lose that race and everything's okay. So I suspect we're going to get as many as we can. And the question is how well can our power grid keep up with it? With the current retirement slate, I don't think it necessarily can. I think we're going to see, new gas plants built for sure, over the next few years. But you might even see a couple of coal plant restarts, maybe even a new one built There's talk of trying to build one in Wyoming and pair it with carbon capture and sequestration. Occidental has great infrastructure to do that out there, and the economics work if you can sort of take the rails out of the equation. If you do like a mine mouth plant or something close where you could either truck it a few miles and then hook it up to a regional power grid, that's something I think that could probably work. And I know some other people have done some work on that, and with with the carbon capture credits, it's probably a 200 million EBITDA business for a 300 megawatt plant. And without the credits, it's like a $100 million EBITDA business. So there's money to be made there. It's just a question of it's like a corporate development project, right? Can you herd all the cats in the same room and get them to all have the same goals? Coal producers don't know how to run power plants. Power producers don't know how to mine coal. So this is really like somebody I think outside an outside entity has to kick some money into it and start to build those public-private partnerships. I think over time, but somebody will do it. It's just a question of how quickly, and then does it become a repeatable task? I guess is probably the next question.
Do you need them to? I mean, do you even need AI and data centers and stuff like that to ramp up in order for this thesis to work out? I mean, is this kind of a cherry on top, or is this the whole cake?
No, I mean, honestly, I think over time, if we're not building any new baseload, we can't really afford to retire any regardless. I mean, power demand hasn't fallen. You get into very difficult waters, which we saw, during the winter storm back in 2021 in Texas. When the gas doesn't flow, you need other baseload energy there. Renewables aren't going to work in extreme weather. You need some sort of coal backup if gas can't flow, and then if you don't have that, you need diesel. I think that was a bit of a wake up call to the Democratic Party here, and it's kind of the peak, green energy transition chatter, and it kind of in fact it's fallen back so much on the left here in the U.S. that Jennifer Granholm, who was not in prior times not a big supporter of nuclear energy, was talking about how great nuclear energy was when they opened the Vogtle plant down in Georgia. And this DOE, like under Biden, gave like a $1.5 billion grant to a coal facility in Indiana to do coal to ammonia with carbon capture and sequestration. So, the politics of necessity often outweigh ideology. And I think that's kind of what we've seen here over the last couple of years, and we'll see if that continues. As the regime changes here, I hope Democrats don't necessarily move backwards on that. I'll certainly do my best to try to keep them to hold the line, but we'll see. People get very reflexive with their emotions when they're challenged to some degree. And if we get really contentious, we might lose some ground on the left. But in general, I think that pace of coal plant retirements, if we don't build any new AI data centers, is going to be much slower than even what's listed on paper there.
The politics of necessity over when the emotions or something along those lines is what you said. That's a very good quote. Had to write it down here. And I was only half jokingly, we'll get to, I do want to talk about nuclear, by the way, something you touched upon as well, especially when we get to China. Hopefully we'll get to that. But only half jokingly that I say that that part about my neighbors in the beginning, because I don't ever talk to them in the first place, or anybody in real life for that matter. But that's a conversation for a different time. There is also truth to that joke, though, because each time I've heard or read someone bring up coal, the comment section always has at least one, but often a couple of ESG enthusiasts who are against it, often emotionally, right? And we could talk about for hours about the cost benefit analysis from an ESG perspective. So that's not where I want to go. But I'm wondering how much influence is ESG and kind of the move and those emotions. How much influence might that have on the coal investment thesis? And more importantly, where do you see that trend going over the coming months and years?
Well, I mean, it's been a headwind, right? I mean, the access to finance for the coal industry has been slim to none over the last few years. They've had to look elsewhere. You can't go through necessarily traditional investment banking routes, although I think that's starting to change a little bit. Politics of necessity and all, right? But the ESG narrative has softened as well because it's failed. Like you can't square peg round hole a solution or wish something into existence. You need a process to go from step one to step 100. You can't skip over steps 2 through 99. And that's in order to sell something, which is basically what politicians do, right? You have to make an argument. And the argument that they make is, well, we can just put up solar and wind and poof, there you go. And that's a really easy story to propagate, whereas the reality itself is much messier and varies from region to region. It's complex. And nobody wants to hear a complex story. You can't repeat that to your neighbor, or to your coworker at the water cooler. You need sound bites. I heard this on, MSNBC, or I heard this on Fox or whatever. That's how people share information personally. On Twitter, it's like we got 180 characters to make something work, and it's either pithy and poignant, or it's just it just goes into the ether. So the difficulty is that you can't plan a future on a story. Eventually you have to have a plan, and the plan failed for lack of a better turn of phrase. Myself, like I'm politically aligned left of center. And I think, like I said before, like I think those goals are good goals. I think it's incumbent upon the developed world to try to ease their use off of carbon, provided that we can, so that developing countries can have greater access to inexpensive energy.
Yep.
And I think that's the human thing to do. Period. Stop. So I'm okay with the goal, but we have to be able to go, well, we can't do this in 10 years. We can't do this in 20 years. What can we do in 5 that's achievable? And then let's go take those steps. And then let's get another, 5 to 10 years and see if we can achieve that. And if you can't, or if things start to break, like you got to pull back and reassess. And that's okay. Like it's okay to do that, but like just you have to tell your constituents what your plan is, and that's where we've just failed, right? It's a binary narrative world now. It's either the green energy is going to be amazing, or fossil fuels are everything, and the truth is a lot messier than that. And as analysts, we have to live in reality, and we have to take data as it comes. We can't allow our own ideologies to come in and overrule our sense of logic and reason and fairness. Data speaks for itself. And right now, at least to me, the data is showing that we can't move as fast as governments want us to move on those issues. So we need to slow down and see what we can do to solve the difficulties that we have in the near term. And, to the extent that if we're going to build data centers and maybe we have to build some new coal plants, maybe you throw artificial intelligence at the carbon problem to see if it can have some greater success than we on that front. I mean, there's more than one way to solve problems, but you first at least have to agree that there's a problem, and that's kind of where we failed sort of as an energy culture, at least in the United States, for the last few years.
Don't worry, we're going to figure out the Dyson sphere any day now.
That's right.
Newcastle coal futures, when I looked at them just before our conversation, were trading somewhat below 140 per ton, which is also give or take the level they were trading at back in the early winter of 2021, where the butter of coal bubbles started, if you will, which lasted 2 years and took coal prices to, I believe, almost 450 a ton or something like among those lines. But so for simplicity's sake, a tripling prices in that period. Are we ever going to see a bull market like this again? And what would have to happen for that to become reality?
Well, I mean, there were two things that sort of contributed to that, right? One was just shaking off the rust of COVID and restarting everything and getting supply chains moving, et cetera, et cetera. And that was problematic in and of itself. Just getting, coal or gas or whatever from point A to point B, finding the people to do that, amidst high shipping rates, everything was mooning at the same time. All commodities were. If you look at a chart of just put up all commodities, I used to have one when I had a terminal, pretty recently, but uh, they just all go up and to the right, for the entire duration of, from the COVID trough to, the end of 21 into the start of the Russia-Ukraine war. The whole commodity space kind of did that in unison. It's fascinating to watch play out in real time and also a little scary. Um, there were two things that contributed to that. One was a supply chain restarting. Well, the second one, I guess, was the Russia-Ukraine war, but the third was the fact that governments had, from a regulatory standpoint, pushed down on specifically on the coal industry for so long that a lot of mines had to shut down. When those mines shut down and then demand all of a sudden reaccelerates, there's no incremental supply that's available to come to the market. So you get what you get, and you don't get upset, and you pay for it, whatever you have to pay for it. Natural gas did the same thing. Natural gas storage in Europe was incredibly low. People were paying whatever they could in the wake of Russia Ukraine. Russia was a primary thermal coal supplier into Europe. Had to go elsewhere to find that. And the U.S. used to be the swing supplier to the world. We could ramp up production and get an incremental 50, 60 million tons of coal out to the global market. And we've regulated ourselves out of that ability to do that. And companies now also don't want to take that risk. They've just, they went through a round of bankruptcies leading into the pandemic, and now it's like their balance sheets are clean for the most part, and they just kind of want to take care of business, go mind the operations that they have, and we're not really talking about much growth. We're not really talking about anything but good old blocking and tackling, generating free cash flow. So in that environment, there is no incremental supply. The spot price becomes infinity. Whatever you're willing to pay for it. Will we see that again? Yeah, it's possible. Any sort of production outage, in Australia, if there's usually it's a weather event. You get about one, weather event every 5 to 8 years in Australia that either shuts down the Queensland coking coal mines, or you get heavy rains in New South Wales and thermal coal markets tighten up, or it disrupts activity at the ports and the ship queues back up. That could happen. Should that happen and the U.S. is again unable to increase supply into the global market, yeah, we can see, coking coal prices, go back to 400 plus. I think the Russia-Ukraine peaks were probably special situations. I don't know if we'll see that again, but I think we can see 400 plus in a supply constrained environment where end users have to scramble to find tons. You can see each of them, maybe not 600, 700, $800 like in the before times, but 400, I think, definitely in the cards for both meta and thermal. It's possible.
Is that only during a black swan event, though? I mean, the Chinese announced this fall, I believe, that they're producing almost 5% more coal than last year, but their demand has also gone up with thermal power generation going up. 10% is what I wrote down, which was coupled with a 13% increase in imports. And I believe they're now importing record amounts of coal. And that's even without mentioning your, India and Mongolia and Vietnam, and with them, global coal consumption, so everything together, is at an all-time high right now, with more growth this year as well as 2023, if I read that correctly. So again, given that high demand that we have here, and prices are still kind of sitting at the range there right now, so 140, and they've kind of ranged for a while now. Do we only see higher prices during a black swan event, or what else could happen to have sustained higher prices?
Sure. It's a tail risk event when you see those 400, plus dollar prices. Absolutely. Like that's, some kind of an act of God or a mining accident. I mean, there aren't really any upside surprises in production, right? Very rarely do you get
Yeah.
somebody who's out producing their capacity or, hitting a really good spot. It just doesn't really happen. If
This is not
anything,
uranium, folks.
that's right. Yeah. I mean, if anything, you'll see, supply surprises to the downside. And when that exceeds what the available surplus is, then yeah, we'll see that again. But yeah, that is a right tail thing. And like I said, about every 5 to 8 years, we have one big event where prices double, go up 2.5 times, and then turn around and come back down to earth. I mean, you look at the chart for thermal coal or coking coal or whatever, you see that now. But the other thing that you see when you look at those charts is if you look at before COVID versus now, the baselines for each of them have risen pretty substantially. It's going to be very difficult to get thermal coal prices, Newcastle below 110, 105 maybe. I don't. I'd be very, very surprised if we saw double digits in Newcastle again. And similarly, if you look at delivered into Europe, the low cost supplier there is Consol from the US. And it costs them about $60 a ton to get it to the port. And it called $15 shipping. So like the minimum possible that, ARA or API2 coal prices could be is about $75, $80. Below that, you're kicking out your most reliable supplier. So that's kind of the functional floors there now. That those numbers used to be like, call it 60 and 80, 75 or something like that. And cost inflation has pulled the whole curve up, by 30, 40% over the past few years, whether that's supplies or labor. Labor inflation has been huge. That's going to relax a little bit as mines shut down over time. But I mean, by the same token, we don't have enough mining engineers to fuel the future. So, what are the salaries for those positions going to do? I mean, they're just going to go up. Maybe we have fewer of them, but they're going to pay pretty darn well. So,
Yeah.
it's hard to see the air let out of the tires, so to speak, on costs really anywhere. So I think we have a much higher functional floor than in the past, and for companies that used to be incredibly concerned about their debt and their balance sheet, I think there's a little bit more flexibility now in this new pricing regime, if that makes sense.
Yeah, for sure. And we don't have enough mining engineers because some strange folks have started taking YouTube as a career now. I don't know who do such a thing, but it happens apparently. Transporting and logistics are an issue as well. That's something I want to talk about for sure. But just
Mhm.
to the point of China and India, as I went through that data and I'm looking at it right here, I was thinking, is it not a risk for the thesis that over half, or even I believe if you add India to China, it would be close to 2/3 of global coal demand, depending on two countries, again, that being China and India? Because what happens if there's only a 10% decrease in demand from each country? That's a 7% global decrease in demand. So is that not part of the risk for this thesis?
Sure. Yeah, I mean, again, it's very rare that you see upside surprises, on the demand side. Anyway, AI data centers have been like one of those few, like, oh wow, we need more power sort of moments. Yeah, if India doesn't perform as a country, which and there's risk of that, or alternately, does China feel that it has to force its own output up to the point where India doesn't have to grow quite as aggressively domestically? Maybe they import cheaper material from China. Like, yeah, that's kind of a risk over the longer term, that hasn't played out yet. I mean, India and China don't really like each other, but that doesn't mean that won't mitigate. Throw some water on the throw some water on the fire of India, because China and India basically right now are going to flip places. One's going up, the other's going down. India is going to be the incremental growth story for metallurgical coal over the next 40 years. Certainly over the next decade, there's a big build out, and that's if it goes as planned, as companies have reported, it's going to offset the decline in China blast furnace production that most analysts see.
Mm.
China's hitting peak steel right about now. And to give you an idea about how telegraphed that was, 10 years ago when I switched over from doing coal asset level analysis at Wood Mackenzie to steel and iron ore, uh, peak steel we had projected for like 2023, 2024 in China. And here we are, and it's kind of happening. So steel is relatively predictable as long as you have stable growth. If we have some kind of like global economic crisis or some kind of black swan event that doesn't have to do with coal, but has to do with generalized economic conditions, there's definitely a chance that that could really hurt the coal trade
Mm.
at that point in time.
But do you expect coal demand in China to be kind of consistently lower and lower over the next couple of years, or does it kind of stay stable where it is right now?
I think it kind of stays stable where it is. There might be a little bit more growth on the thermal coal side, but I mean, they're the biggest producer of coal in the world. And if they want more coal domestically, well, they can marshal those resources. Um, where China has a difficulty is on very high quality coking coal. And we can get into the properties of what that constitutes, later on in the conversation. But that's why they have to go into the market and import met coal tons, either from Australia or from Canada or from the United States.
Mm.
There's just nowhere else really that supplies them. It's very specialized kind of niche material that provides stability to the coke that holds up the iron ore burden in a blast furnace. If that coke is brittle, or if it's not strong enough to hold up the burden and it crumbles, then the molten iron can't trickle down through the little, stacks of baseball-sized material that you have, and it pulls up, and God forbid there get any moisture in it, but can go boom. So coke strength is very important for the integrity of maintaining your blast furnace, preventing accidents from happening. So I don't think they can get away with just using terrible coals completely. They need a little bit of coals that have a strength contributing property to prevent or to maximize productivity, one, and then to prevent from a safety standpoint, prevent
Mm.
accidents.
I hope all seven of the people who are still listening are paying attention to context, because when you talk about moisture and then having booms, then that could be taken out of context way easily. But the what I was getting to with the China thing is I watched a clip on Twitter. I was doing research on Twitter, as one does apparently these days, from one Dr. Christopher McGlad or something along those lines, who's apparently the head of the IEA's energy supply unit. And he was saying that the coal demand reduction he expects to see from China in the next 10 years will be equivalent to coal demand for the rest of the world as a whole. Do you think he's exaggerating? Because it kind of seems like he is.
Yeah, I don't think it's going to go down quite that much. I mean, I think it'll probably fall over a 10-year period, but probably like 5-10%. I mean, I don't have a number on it offhand, and I haven't done a projection on China in particular. I tend to be a consumer of data from China as opposed to a generator of it.
Yeah.
But yeah, I think that's probably a bit overstated. And we also have to keep in mind that if that really is the case, on the thermal coal side, well, then they'll just shut down mines domestically. And to the extent that they need seaborne material, they're buying seaborne material for a specific purpose, whether it has a certain calorific value that is integral to their power plants, or again on the met coal side, it has a strength contributing property that is meaningful to the integrity of their coke plants. So
Yeah.
one or the other. That's probably overstated, but again, it's government energy agencies. What are you going to do?
That's fair. Yeah, well, that really picked up my interest because, and also I thought I want to talk about this is nuclear in China. So what I'm thinking is along the lines of, could the speed and the scale at which they're building nuclear make a dent in their coal demand? That's kind of along the lines of what I was thinking.
Yeah, they'll need less over time if they're going to build out nuclear to the scale that they say they are. But without seeing a map and where coal plants are, it might not offset quite as much. It might just account for some level of power demand growth or alternately retirements that are already planned. I mean, they've had a lot of these plants are relatively old for them, so they could be retiring and replacing, or there's a lot of different circumstances where it might not be the right way to look at it, I suppose. So rather than speculate on it, I'll probably just say it's better if they prioritize nuclear because I mean it's the only proven zero carbon technology we have at the power gen level that you can deploy at scale. But then also for them that allows them to kind of carve out some space on their emissions if they need to grow elsewhere, if they need to build other coal plants somewhere else as they're retiring those to maintain baseload. They have the ability to do that.
So you can be a coal and nuclear bull at the same time.
Yeah, I mean, hey man, I've owned Cameco and the physical uranium trust for a good long while. I don't even look at what the share price is. When you guys get sad, that's when I'll sell.
I wish I was as wise as you. And I made a joke about this on Twitter multiple times, but I over-engineered my portfolio. Long story. I should have just bought Cameco and the physical trust, like every obvious other thing out there, but I didn't. Point being, and I kind of, I'm quite a few moving particles here, but I'm kind of getting a better idea of how it all works. The host said, knowing full well he might forget most of this before his next sentence. But I'm getting a better understanding of the supply and demand dynamics. But there also seems to be another element to this thesis, which is the supply for the right demand at the right time in the right place, if that makes sense. So where I'm going with that is essentially logistical issues for the different types of coal, so met coal and thermal coal, during different times of the year. How big of a role does that play in the coal thesis, and what does that look like?
It does well. Both of them have some degree of seasonality. In thermal coal, generally your biggest burns are going to be in the winter and in the summer, and then you restock in the shoulder season is what we call it, right? That is a very specific term to thermal coal and power generation, and those sorts of things. But it's also true of met coal. Steel plants generally only come into restock 2 times a year, and they generally kind of coincide with late winter and late summer is kind of when those times are. So during those periods, you get these big runs up as companies come in to hedge their deliveries for the next peak demand season. So there can be shipping bottlenecks or rail bottlenecks or those two things during those times of high market activity. But I think from a logistics standpoint, the bigger sort of question mark in the coal markets right now is what is Russia? What's going to happen with Russia as we move into a new regime in the United States that is going to be, I don't want to say friendlier toward them. It's not the right word. But we may see an end to the Russia-Ukraine conflict relatively quickly. When that happens, I mean, the Russia-Ukraine started the whole boom, and then people have wondered sort of openly, are we going to get a bust on the other end of that as supply chains instead of working to suck all the Russian coal out of Europe and the Asia Pacific region and put it solely into China and India. Is that going to work in reverse, and then everybody has to, change their supply trade routes? I don't know. I don't think so. Like my sort of working hypothesis right now is I don't think Europe is in much of a mood to, give Russia money for hydrocarbons at this point. So I think their sanctions are probably going to stay, and to the extent that the new regime in the U.S. is antagonistic to European leaders, that the reflexive human thing to do is, well, we're going to stand pat on Russia and we're going to be tough and all those sorts of things. So I think that's reasonable. In the Asia Pacific region, like I'm sure South Korea would like to take more Russian material. I'm sure Japan would in a vacuum, but whether they do or don't, that's too hard for me to tell. So I think the status quo mostly stays the same. The other interesting thing that's happening in Russia from a logistical standpoint is their rail deliveries have been sort of marshaled for the war, and there aren't as many available to move coal across the country. And they have they move coal way vast distances. from the Kuzbas all the way out to northern ports and eastern ports and coal moves every which way in Russia. So Siberia is pretty easy. It goes to the east and gets exported. But what happens with coal production in the Donbass and the Kuzbas, which are currently under siege? There are rumors that some of the industry is kind of collapsing at the moment, so we don't know whether that supply is going to be available or not. There are rumors that the logistical problems that they have are going to persist even after the war. I don't know. I don't know necessarily how that's going to play out. But again, it's like I'm sort of functioning from the standpoint that I don't think the status quo is going to change really quickly. I think all that Russian material continues to go into India and China, and that's just sort of how it is for the time being. So I'm not projecting any change in trade flows, but that if that situation moves in a way that I'm not necessarily anticipating right now, yeah, that could be weird and messy for a 3 to 6 month period of supply chains as trade flows adjust. Everything is going to find a home. I mean, we're not bringing on more production over the same level of demand. It's the same amount of production, same demand levels, just moving in different places. But if we recognize that that's what caused the biggest spike in 2022, we should also recognize that that could cause some other consternations or different consternations when that is resolved in the other direction.
Geopolitics within the context of coal seems to be way more complicated than, say, within the context of gold or uranium for that matter too. What is it? How would you rank these events? I know you kind of touched upon it, but what, maybe to summarize, what's the most important geopolitical relationship and what comes after it?
I mean, I think it's China first and foremost. Is China production is China demand for coal going to meaningfully decline per the gentleman from the IEA? Is it going to meaningfully decline on the metallurgical coal side? Are they going to transition to an electric arc furnace system faster? Like that, the way that you have to model the global steel trade is you kind of have to model China independent. So like, do China plus they get supply from domestically, from Mongolia, from Russia. That's the vast majority of it. They have to import a little bit from the US, from Canada, from Australia. Once that's solved, then you can go and sort of take a look at the rest of the world. And most of the rest of the world isn't growing. And then there's India. So are we going to see a recovery in Europe? Well, no. I think we'll certainly see a recovery in Ukraine once the war is passed. I think we're going to rebuild, we're not going to rebuild the Azovstal plant that was, bombed to smithereens, but we'll rebuild something there, and they'll probably get government money to do that. And I don't think that's going to be an electric arc furnace. I think it'll be, a blast furnace. So, taking all that together, you cannot solve the world without solving China first. And if there is downside risk in China, that means that the whole rest of the world has downside risk that we haven't yet taken into account. So I'd say China number one. China could also overproduce and continue to export raw materials. They could export coke. They could export steel like they're doing right now. There's a lot of different ways that can turn out because steel is a complex supply chain. On the power side, it's for them, it's mostly about growth and about how quickly they're going to build out nuclear, whether they're going to add coal or replacement. That's a little bit simpler story, but steel is very complex. Number two is India. What pace is India going to grow at, and how is China's, 5-year plan going to interfere or help India's growth? I think that's number two. And then, in my view, I think the number three question we have to ask is, do we get a European recovery in manufacturing at all? And then do we get a Ukrainian recovery? I think probably in order, those four, those are the geopolitical things that we need to see how they play out. One of them is directly geopolitical. And then the others are, I think more a function of just general economic activity.
And that's kind of in a not in a vacuum, but separately. So China, India, so on and so forth. What about geopolitical relationships? Is that also important, where the relationship between what you touched upon, Russia and the US, How important is that? And then China and Russia, China and the US, how important are those relationships?
Very. Russia was sanctioned by pretty much every country on earth, but India has this historical special relationship with Russia. So we just turned a blind eye to it. We're not going to, sanction India for, using Russian material. We need them. We need them in the Quad. So India gets to do what it wants. The antagonism with China that is most certainly incoming into the U.S. is going to be interesting. Not long ago, back in 2020, China put a ban on imports of Australian coal and it went to zero. And then that Australian coal then started to go into Europe and push the U.S. out, and U.S. backfilled China. Terrible trade flows, like really costly, movements of material around the world. But they stuck to it for a while because they had a tiff with the former Australian Prime Minister. So how we interact with them state to state at a state to state level over the next 4 years is absolutely going to have some sort of bearing on whether or not that China is going to be an acceptable destination for U.S. coals. My suspicion is they need it, so it kind of doesn't really matter, and it's not really that much anyway in the context of Chinese industry. It's like 1% of consumption or something like that. But that could definitely have some sort of iterative effect. Russia, the same deal. If the floodgates get loose on production in Russia, and there's a mine in Siberia called Elga, which produces a coal that's very similar in quality to the high volatile A metallurgical coals that we have in the U.S. If they produce 4, 5, 6, 7 million more tons and can get that coal through the ports on their eastern seaboard, that could really put a dent in the U.S. High vol price and its ability to go into the Asia Pacific region. So that's an issue as well. I think those are the two probably biggest strictly geopolitical levers to pull in the coal industry. So I think it's a little bit simpler than a lot of these other commodities. I mean, certainly not getting into the politics of Africa or anything like that. Yeah, I think it's mostly just China and Russia, and how do those issues get resolved, and then what does that mean for supply?
Hmm.
So
Where
that's
where does Africa come in all this, though? I mean, I saw that exports to Africa from the US had gone to an all-time high or something like that this year. Again, I didn't write the exact numbers down, but where does Africa come into everything?
Well, South Africa is a big thermal coal producing region, so they're an exporter of coal into the broader world. And they have a mix. They have Indian customers and they have European customers, and I mean that's mostly how they're going to factor in. But have we thought about the development of sub-Saharan Africa like post 2040? I mean, it's not in a lot of forecasts at the moment, and that's something where if there were really rapid economic development in Africa, and they wanted to build coal-fired plants or to do that. I mean, they're getting opposition now from European governments for trying to build fossil fuel plants down there, which is to me is bananas. But that certainly happens. But yeah, if there's a development down there that catches the market by surprise, I mean that's huge upside for. I mean, it'd probably be for thermal coal if it was for anything. I don't think they're going to be a big steel producer anytime soon. But that'd be my guess. It's not quite as we don't have the sort of like Niger coups and global atomic stories in the coal business. It's a little bit more straightforward, good old fashioned Russian and Chinese skullduggery, and that's about it.
Seems just a little bit more matured. Also, based on the talks on Twitter, it also seems a little bit more matured than the market. And I can say that because I'm part of the immature crowd. So far, you've been pretty bullish on coal, Matt, which is not unexpected for the coal trader. And well, actually, that reminds me, that might be a point. But your Substack is called the Coal Trader, not the Coal Bull or the Coal Expert, the Coal Aficionado or whatever, but trader, which means to me at least long and short. What would it take for you to short coal?
To short it, I mean, I mostly invest in my 401k, which is pretty long only. So it's not so much I'm shorting, but I'm selling or I'm reallocating in directions that change over time. Like right now, like one of the biggest events that's happened in the last couple of weeks is Peabody came and bought Anglo's coal assets in Australia for somewhere between, and we don't know exactly how it's going to flesh out here, but somewhere between 2.6 or 7 and $3.8 billion. And they just a few like a month or so ago, they come out with a presentation on this coking coal mine that they're opening, which is going to, organic growth and increase free cash flow. And they're talking about shareholder returns and buybacks. And then they go and they make this acquisition, which is going to eat up a lot of, I mean, for those assets, there's ostensibly no free cash flow until the deal is paid off through, call it 5 years from now, the end of the decade. And they're going to take on debt to do that. So they may even have to use some of the free cash flow from the other business to service the debt here. So it's gone from being a story of, growth and, finally we're going to be able to unleash all this cash they have on their balance sheet into shareholders. And instead they go and do this. And so that's sort of slowly moved down the list of viable options over the next 3 years. So like if you're a professional allocator, and you've been promised shareholder returns, and that's your thesis. And Peabody, by far, the most liquid of any of the coal names. So if you need to put, $50 million to work, you can do that over a shorter period of time in Peabody, more so than you can do with anybody else. You're looking for other places to put that at this point. I mean, my DMs have been filled with like, I don't want to say angry frustrated messages of frustration at that. They said one thing and then they did another, and so they don't know if they can really trust it. So the beneficiary winds up being a company like Warrior Met Coal, who's growing production. They've already the mine's already starting to produce. They're going to bring on a longwall here over the next couple of years. That prices for that coal are going to be pretty good, and they have one of the lowest cost bases of any mine in the world. So now Warrior is like sort of the poster child for growth and for safer plays and stuff like that. And it's a much lower float stock than Peabody is, so the price is probably going to be more resilient. So like as these things happen, you're just going to allocate more toward the safer, more likely higher return operations, and less toward the ones that are digesting acquisitions like Peabody. Now, over the longer term, Peabody's going to be, I think it's going to be great. I think it's probably a wise move for them, just not relative to what they had communicated prior. But like, so it's not so much that we're, they get bearish on any of the companies. I think coal has a very, very bright future, but we do have seasonality. So in the off season, prices come down, and generally the equities will come down with them. And then, pardon me, and then also, companies from time to time, the investment thesis for them shifts a little bit. So like, this year has been, met coal, which has been really driving returns the last few years, has taken a backseat to thermal coal. So companies like Yancoal and Whitehaven have moved sort of further up the list of Consol Energy, which just merged with Arch Natural Resources to form Core Natural Resources. That stock is going to be a beast. But those are mostly thermal coal names. And now met names, which are at a trough in the cycle, are kind of getting a new baseline for those equities and waiting for the next upcycle to start, which should be 2026-ish, 2027. There are a few key mines shutting down. So we should see by the end of the decade prices begin to inflect upward, and God forbid there's a weather event or something like that in the middle that gets us moving and shaking. So bearish isn't the right word for me. I don't like to use that word because it's coal industry's had a hard enough time these last few years without saying, "Hey man, go out and short company X." It's just more there are periods of the year where it's better to own coal than other commodities. And there are periods of the year where it's better to own the other commodities rather than coal. And then, individual companies making individual decisions based off of their, the environment around them. That sort of changes the rankings basically from time to time. But that's it. I mean, everybody's going to have, I think, almost all of these publicly traded stocks are going to have a pretty good decade, if we're being honest. And beyond that, there's probably some question marks as to how robust, the market will be. But when I look in the rear view mirror to the beginning of my career, where I walked into an industry I didn't know that much about, and the buzzword was coal is dead. It's going away. It's for to have the last 4 years, like I'd moved on. I'd written a newsletter with Rick Rule and Sprott. We talked about copper, base metals, and precious metals, and uranium and tin, and all kinds of really really fun commodities. I was diversifying myself away from it, and here over these last few years, like there's a dearth of people who know a lot of details about coal markets and the coal industry, and just out of necessity, I've found myself being pulled back in this other direction. So if that can happen, then certainly I think we're going to have a future that is where coal isn't going away, but is rather going to be doggedly persistent in our lives, whether the Green New Deal folks like that or not. And my sort of attitude toward that is you don't have to be antagonistic toward us. Like, we're here to help. The industry's here to help, and that's all. So we got the memo that there are some folks out there that were upset, but I think everybody out here who's operating is going to continue to do so on a responsible basis, and try to shepherd their assets as best as they can. And like I said, just kind of block and tackle, generate free cash flow, and just try to put one foot in front of the other and keep going.
I did want to ask about the Peabody deal there, but the Money of Mine guys actually saved me some work. And frankly, they did it better. I saw you were on there, so shout out to them. Everyone who wants to know more about your opinion, because that was a pretty in-depth conversation that you guys did on it together with the koala, so people can go and listen to that. What you mentioned here was you think almost all equities are going to do well over the next decade. That's quite the claim. How do you know when you pick companies? I almost feel like, and I don't know the sector well enough to be able to kind of make a checklist, but I'm an accountant by education, so I like checklists. What do I look for in a good company?
I mean, first off, you look for, is the company growing? And what is their attitude toward shareholder returns? I think are the top two things. And both of those, in both of those instances, you need really top flight management. Now, the coal industry is pretty fortunate in that we have a really excellent kind of new generation of leadership that has begun to sort of become prominent, right? The old guard has sort of transferred over to guys who look a little bit more like my age, and they're all doing really excellent jobs. I think when prices are this low, you want to look for the lower cost producers. On the met coal side, that's Warrior Met Coal is probably one of the lowest cost producers globally. You want to look for royalty companies as well. I mean, royalty plays, you take the operational risk out of the equation altogether. Natural Resource Partners, ticker NRP, is another company that's mostly levered to met coal, but it's a little bit more diverse than that. On the thermal coal side, low cost providers, Yancoal, Whitehaven, Consol, ticker CEIX. Like those are the horses that you want to ride when prices are comparatively low to where they've been. For met coal's kind of moving along this $200 per ton level, which is everybody can make a margin at, but it's not the party that it was a couple of years ago. So low cost means you're maximizing your margins on that front. Yeah, I think that's pretty much it. It's like look for growth, look for shareholder return policy, look for quality management. When prices are low, look for low cost. When prices start to go, then you want to look at the higher cost producers or slightly higher cost producers. On the met coal side in the U.S., that's Alpha Metallurgical Resources. I wouldn't necessarily call them higher cost, but the transport component from Central Appalachia to the East Coast of the United States can get pretty high, which is where their flexibility is. But their mine level costs are pretty comparable to anywhere else in the world.
Mm.
Um, but when prices get going really to the upside, Alpha is going to be the one who will have the most torque in a met coal bull market. On the thermal coal side, I got to think about that. Uh, I didn't mention Alliance Natural Resource Partners, which is a U.S. domestic thermal coal play. Um, if we believe that the AI data centers are really going to drive demand, then it's going to also, keep natural gas demand up domestically, which is going to keep thermal coal demand up domestically. And ARLP is a primarily like domestic supplier. Um, and it also kind of relatively low cost, but I can't think of a really like higher cost thermal coal company to go after that would be pretty torquey to the upside there. They're all going to be about the same, I think, on the thermal coal side.
What about something like an Explore Co equivalent for the degens like myself?
Man, I think we stopped drilling for coal in the 70s. So no, there's nothing like that. But every company who has growth projects is sort of the equivalent here, right? Um, I'm trying to think of an interesting. Actually, Jameson Resources has a mine in Canada called Crown Mountain. Uh, I think they're publicly traded. If not, I think Bathurst Resources also owns a piece of that project. But I think that project's going to come on probably latter half of the decade. There's a company not yet in production called Colonial Coal, which has really high quality assets in Canada. The difficulty there is we don't know who's going to mine the coal. There's not a mine plan yet. They're going to have to sell the projects to a developer who comes in and
Mm.
develops it. There's probably some permitting risk involved with that because it's British Columbia. Um, but there are a few companies sort of like that. I don't think there are any other developing ones offhand. I don't have a list in front of me. This is just off the top of my head.
Mm.
But those are a couple I think to kind of kick the tires on. And then the micro cap of or really the mini cap of the industry is tiny little Corsa Coal, which is basically a single asset producer in Pennsylvania, which was brought back from the edge of extinction many years ago by Sprott, and I think the Lundins still have a small stake in it. Catches the bare minimum of coal window shoppers. The ticker is CSO.V. They could be potentially interestingly torquey in a met coal bull market as well. It's one we're waiting and watching for, but it's a little bit higher cost. So and incredibly illiquid, so you have to watch out for that one. But for the degen crowd, like that's probably the best I got for stocks to track in the coal space.
I told you it is way more mature than the other markets that I'm involved in. If that's your worst that you can do there, but it's because essentially what I'm getting out of this is that the highest risk with these companies is like you don't have that geological risk the way you do with discovery or pre-discovery plays, and a lot of the other risks are not there. The main thing, well, there's still a lot of risks, and the main risk here would be operational risk, if I get it correctly.
Yep. Yeah, that's right. I mean, the Grosvenor fire in Australia this summer is sort of the poster child for things can go really wrong really quickly in a coal mine. Those seams in Australia can be really gassy. And I mean, Peabody's Centurion mine that they're restarting used to be called North Goonyella, and it caught fire in 2018. They've spent 7 years almost rehabilitating that, 6 years. So it's always a worry on the operational side. And mining safety's come a coal mining safety's come a very, very long way from the 1930s and 40s and even into the 70s. As technology's gotten better, our ability to make sure that people can go home from work has gotten a lot better too. I mean, I used to play where I grew up in West Virginia. There's a park called Consolidated Park. It's now Mary Lou Retton Park. It's a different story, but Consolidated Coal Company is Consol, right? And there was a really famous mine disaster in Monongah, West Virginia. I forget what year it was, but the whole park was, basically like a community rehabilitation project following that coal mine. There's a big monument there to the miners themselves, and like just growing up where I did, it was very visceral that it was a very dangerous job, and that a lot of people lost their lives doing it. So that's part of the culture, here in the U.S. at least. Like that's everybody takes that incredibly seriously, and I mean, I'm not sure investors really, they probably take a snooze through most of the safety discussions on the earnings calls and stuff like that. But that's incredibly just important to, your company culture, your working culture, and all those sorts of things. And it's operational risk is by far, the biggest concern I think that anybody has for sure.
Yeah. It used to be a big thing here in Belgium too, by the way. I mean, in the 19th century, Belgium was one of the first countries to start industrializing very aggressively on the back of coal, and there was a coal hub even here in Belgium. It was actually a pretty big thing. There's um, a big semi-famous city. The name is Liège, and it was built essentially around the coal mining industry. That's where the lawyers and everyone was, and yeah, that definitely no longer is the case. From a portfolio perspective, Matt, how is that for you? You said it's mostly in your 401k. What percentage of your portfolio personal is in coal right now?
Uh, it's a good question. I have a 5% position in Warrior Met Coal. Um, I have a 2% position or 3% position in BTU that I picked up on the sell off here, as it has come down from, it was up $30 not long ago when they were talking about shareholder returns. It went all the way down to 23 yesterday, and I think I had a limit order get tripped.
Hmm.
And that's all I have right at the moment. We're heading into winter, which should be generally pretty supportive for coal stocks, but the China overhang on the met market has been really disruptive. So having extreme exposure to the coal industry, to that part of the coal industry this year has been generally inadvisable. Like when I pared back and rebalanced my portfolio back in February, March, before shoulder season really hit, and took exposure down. I had was very surprised at how far met stocks came back down to earth, in prices, and all of that was China driven. So now we're on the other side of the cycle, but my exposure will probably get up in the order of like 10 to 20%. If we do actually get an inflection, we start to move up to the upside. But yeah, right now I think it's like 8% total. My uranium exposure is like 20 to give you a comparison.
Oh,
So
okay.
yeah. So it's it just depends on the season. But when during 21 and 22, I was as much as 75%, 80% allocated to the sector.
Hmm.
But that's just because we knew that none of the analyst community had really digested just how big a pile of cash was getting pushed through these companies over the next few years or so.
Hmm.
So but yeah, right now pretty minimal. I'll look to probably see if I can step it up in January, probably start of the new year. But I'll take whatever the market gives me. It's not really that I don't need to have maximum exposure all the time.
Hmm.
Certainly when it comes to like February, March, I'll probably dial it back pretty substantially because we could have a pretty nasty shoulder season, in Met next year. in particular. For thermal coal, I don't really know. We have LNG export facilities in the U.S. almost certainly coming online as soon as possible, as soon as the regime change happens. That's going to tighten, the domestic gas market here in the U.S. But I think the Qataris are bringing on a number of LNG trains as well, so that's going to loosen global markets to some degree. So, you know, to the extent that happens in like Q1, late Q1, or through Q2, it's that's the time to generally reduce exposure and then start to ramp it back up in call it June, July, late June, early July is the time to start kicking the tires on that.
Hmm. You guys gonna start a uranium newsletter anytime soon?
Well, I mean, one of the things that we'd like to do, like I think what we're going to wind up doing at the coaltrader.com is like the website's toward more sort of institutional offerings, big thermal coal and met coal studies in a corporate service. And then we'll, for the Substack, which is, I mean, there's a lot of retail involved in the Substack. Like we'll put all the insights and you know, uh, we'll try to keep a portfolio there and, trade alerts and like those kinds of things will probably be delivered through Substack, which will be sort of a subset of the institutional products we're developing on the website. I
Hmm.
think that's probably the direction that we're headed. But right now, kind of everything's all the same, right? You can subscribe on Substack at the coaltrader.substack.com. You can subscribe on the website at thecoaltrader.com. There are some enhanced charts and things that we have on the website that we can't put on Substack. So that's kind of the difference between the two right now. But I'm going to make a more clear delineation of that, I think, going into the new year. So
Hmm.
to that end, we'll probably run some specials here in December to try to, get people in at these prices, while you can, because it costs a little bit of money to develop. May have to raise them here in the new year just a little bit. So.
How's that worked for you? Kind of the trading around seasonality. Have you, or do you keep a track record or something? Then how's that work for you?
I mean, what I try to do is just to rebalance. I still have a lot of cash in my portfolio that I haven't reallocated because I've been busy. But from Philo, I sold Philo, and that was like 30% my portfolio or something like that, and I haven't
I see.
really reallocated most of that cash yet. So I've been too busy with other things to worry about it. It's sitting in a money market account collecting, interest or whatever, which is fine. Um, but when we do get development done, that's probably going to be, I think, a core part of the Substack is to talk about allocate. We may even take some revenue from, the publication itself to put into something that's like, here's the public version of the holdings and stuff like that. And I would like to diversify the commodity chat that goes on there. Like I've been all coal all the time out of necessity, due to work and those sorts of things here this year. But I would like to talk more about kind of like the diversified commodity space and kind of treat a portfolio like more like a diversified commodities ETF, so to speak.
Hmm. I've been asking everyone who writes a newsletter this question, so don't take it personally. But why sell a newsletter in the first place? And there's not that much for
Uh-huh.
call out there, but you seem to have a very, very, very thorough understanding of this market. You say you have a good track record. Why sell a newsletter in the first place?
Well, that wasn't my intention. So I was a subscriber. The Coal Trader was started by my friend David Dyer, who at the time I think was working for Natural Resource Partners. And he just did it because he had to do it for work and he was investing and trading in the space, and so this was kind of his like personal blog for a while. But then as he developed the website, like I had I probably had $30,000 in subscriptions to all these other price services and stuff like that, and I was like, you know what, I don't really need it. I can just subscribe to the Coal Trader, and that's really all I need to function from a research perspective for me. But I'm a consultant by trade.
Hmm.
So I make, the vast majority of my income, doing direct consultancy for industry and for funds and for all kinds of things. Like I have in the past 2 years, I've had clients who oil and gas, who are nuclear isotopes, hydrogen, um, solar power company, like all over the map. So I kind of anything that is commodities or energy related, I generally will consult for. But when David transitioned roles from working in NRP to he's now uh, working for Ramaco Resources, ticker METC, another uh, growth stock in the met coal space that you should pay attention to. He was going to shut it down, and it had become such a resource for me. I was like, well, is it, how would you, and he just asked me point blank. He's like, do you want to take it over? And I was like, it was not on my bingo card, but yeah, let's keep it going because it's too good of a resource not to have available for people. Like nobody can go, if you're a small family office with not much of a research
Yep.
budget, you can't go buy a Wood Mac product for $50,000. You can't go buy a CRE product for 15,000 or $20,000. You can't go buy McCluskey for whatever. If you got a Bloomberg terminal and that's it. You need something whereby you can get a feel for a certain sector, and you have to find like your guy who talks about it in a way that sort of you understand. And coming from the newsletter side, before, one of the superpowers of the newsletter industry is to take complex topics and be able to break them down in a digestible fashion for generalists and other non-experts. And that's kind of what I've done my entire career, whether it be at WoodMac or in the newsletter space or even now. Prior to that, I was a teacher for 10 years and a musician. So this is just a natural evolution of that. And the other thing that it does for me is it gives me a chance to be an advocate for the industry in a public way, which is probably the bigger reason that I said yes. Like the industry itself is very near and dear to my heart, mostly due to where I grew up in West Virginia. And it's gotten such a negative reputation over the past couple of decades that this allows me the opportunity to come out and be a positive voice for the industry. I'm never going to be antagonistic to people who have qualms about carbon emissions or anything like that. I generally agree with those principles, but like there's a role for the industry to play, and it's going to be around for a long time. And I just want people to know that like it's not because it's coal is great or better than anything else. It's just because we need it, and that's it, plain and simple. And so if we need something, let's maybe not throw the baby out with the bathwater. Let's find a way to talk about it in a pretty informative and non-combative way. And I think for me that's probably more important than anything else. And the newsletter as a delivery system for that kind of messaging, I think, is really powerful.
And you do it because it's simple, and we've kind of come full circle. That was the answer where that's the answer to the first question was the answer. I gotta say, the mountain state sounds way cooler than the old line state. So I don't know why you ever moved. But
Well, it's just job. I had to move for a job and a girl.
that makes all the sense in the world. I did the same. I know how that feels, the latter part. Good, Matt. I've been through. I'm getting a very good understanding of where you're coming from with coal and what's happening with these things. Maybe I shouldn't say a very good understanding, but some understanding, and hopefully we can do it again soon. But what am I forgetting to ask you? What's important to talk about here at the end that I failed to bring up?
Uh, I mean, we kind of hit the highlights, right? I mean, we talked about, the necessity of thermal coal from a power generation, from baseload power generation standpoint. We talked about the necessity of strong coking coals, to as a structural component in a blast furnace, and how blast furnaces, aren't probably going to go away as quickly as many have thought. We talked about some of the equities and how to think about capital allocation. I guess we didn't talk about risk management, but that's way too personal, and I'm not qualified to make those give that advice anyway. Um, I'd probably say there's one last thing we didn't talk about. It's that it, it's that the industry itself, in all commodity industries, are really complicated, and there's a lot of things to get wrong. And the best I think that we can do as analysts is to operate in a kind of Bayesian fashion. I can't predict what China's going to do any better than anybody else. When they take an action, I'll have to react to it, and that can change, what the outlook is for the good, maybe for the entire sector. Um, and so I think that's important for people to sort of bear in mind, especially as we move into what I think is going to be, a period here where we're going to have a lot of geopolitical tension. Pardon me. A lot of geopolitical tensions that we don't necessarily know how they'll be resolved. And one fallible human's actions on one side of the pond can affect another fallible human's actions on the other side of the pond, and then before you know it, I've got to throw my whole forecast in the garbage and start anew. But that's kind of the world that we live in. Like this is going to move really quickly, and it's going to be incredibly interesting. There's going to be a lot to talk about. There's going to be a lot to write about, but I'm not sure how right we're all going to be as an industry of analysts, over the next few years. And I think that's important to keep in mind, when you're investing in the commodity space, when you're trying to learn it, is that there's a lot of moving parts, and these are all, difficult, segmented industries, all operated by fallible humans, and it makes for interesting times. But it's as predictive as we like to think we are. It's You got to stay frosty. Probably the best thing I could probably say to anyone who's out there looking at investing in the mining space.
Stay frosty. That's a good way to put it. And it's MF Warder on Twitter.
That's
Although
right.
you did recently lock your account, so people are going to go through a little bit of verification when they want to follow you. And it's thecoaltrader.substack.com. And thank you so much for doing this, Matt. It was great.
No problem. Anytime, Antonio. Love the podcast and happy to be on anytime.